Hello and welcome to my section 6 video. Today we will be discussing portfolio risk and return analysis. So essentially we are starting our first job and want to invest $10,000 with our sign-on bonus. We have a colleague of ours who suggests going all in on Tesla because it is quote-unquote the future, while your parents say to stick to with an S&P 500 index fund and you yourself want to build the portfolio. So using the 5-year hypothetical historical data below, we're going to do this. Well, considering our key correlations between Tesla and Apple, Johnson & Johnson and ExxonMobil, Tesla and Johnson & Johnson, and the stock bonds for about negative 20%. Questions we're going to answer. What happens to risk when you combine with Tesla? Can you build a portfolio that beats the S&P 500 returns with less risk? What's the optimal mix for someone at your age? How does correlation create the free lunch of diversification? So as soon as we get done answering these, we will approach the situation using the Gyro framework, answering these following questions as well, such as investment goals, what risks concern you most, visual returns, volatility, volatility, incorrect correlations between optimization, building our own portfolio, compare the portfolio metrics with benchmarks, and then answer the question is how does the changing mix affect risk and return, what surprises about the diversification benefits, and so on and so forth. So if we move to my Word document, so basically here we have our friend versus our parents' financial advice. So our friend chooses Tesla. They have an average return of about 35% based on the 5-year historical data, with a standard deviation known as risk of about 60%. So it has a higher risk for sure. Compared to our parents' pick, the S&P 500, which has about a 12% return, but it's 18% balanced, 18% standard deviation. So it has a balanced risk. My analysis of this, our colleagues suggest to go all in on Tesla, 100% allocation. Offers the highest potential return of about 35%, but comes with an extreme level of risk of about 60% deviation. The single stock approach is not investing. It's honestly speculation, risk a major portion of your bonus on the fortunes of one volatile company. While Tesla is exciting, 60% standard deviation means your $10,000 could easily drop to $4,000 in a bad year. Meanwhile, your parents' advice to stick with the S&P 500 is pretty sound for a conservative baseline. It offers a respectable 12% return with moderate market level risk of about 18%. This is the standard diverse set and forget option. So if we want to build our own diversified portfolio, the goal is to beat the SPY's 12% return with less than 18% risk by leveraging diversification. The keys to reducing risk lies in correlation. Correlations is the measure of how two assets move in relation to each other. So for the stock bonds correlation of about negative 20%, this negative relationship is the core of the diversification. When the stock market is doing poorly, the Vanguard bond, BND, often holds steady or increases, acting as a shock absorber for the portfolio. For the Tesla and Johnson & Johnson correlation of about negative 10%, Tesla is a high growth high volatility stock. J&J is a defensive, stable healthcare stock. Their slightly negative correlation means they tend to move independently, or sometimes in opposite directions, which further dampens overall risk when combined. A recommended optimal mix I would give is, given our age and the long time horizon, we can handle more risk than the SPY's 18%, but you should seek stability still. So here's an aggressive but diverse portfolio that aims for high growth while managing volatility that I've created. So if we go with Tesla, I would say we allocate about 30%, which is going to be $3,000. Our expected return will be 35%. It has a high return mitigated by the J&J and B&D. Apple, tech leader, would be about 30% as well, $3,000, with an expected return rate of 22%. High return, lower volatility than Tesla. J&J for stability, we would invest about 25%, $2,500 and you can expect a return of $9 or 9%. This provides stability and benefits from negative correlation with Tesla. And B&D, this is our risk reducer as well. We would invest about 50% at 1,500 and get an expected return of 3%. This is crucial for lowering the overall portfolio risk due to negative 20% correlation. So this portfolio is designed to beat the S&P 500 and return with only marginally high risks. The estimated portfolio return would be our negative percent, our percent of 30 times 35% return plus the other 30% of our money times our return rate of 22 and 25% of our money used multiplied by the return rate of 9% and 15% of our money used times the 3% of the return rate, which equals about to be 19.3%. Volatility. While the exact formula is complex, the negative correlations, especially the 15% in B&D, would push for the portfolio standard deviation significantly lower than a weighted average of the component's risks, likely keeping it around 20 to 25%, which is still much more better than Tesla's 60%. So the risk analysis of this, the risk known as standard deviation of the combined portfolio decreases substantially because of the negative 20% correlation. If you had about 50% Tesla and 50% BND, I should say, sorry, and they were perfectly correlated, the portfolio risk is much lower than 32%. The BND acts as an anchor, pulling the average volatility of the Tesla shares down and providing downside protection. This is the most dramatic benefit of the diversification in this scenario. And moving on to our driver framework, we must define, our investment goals. If I go back here, we must define investment goals. What risk concern you most? Your investment goal as a new professional with a long-term horizon is capital appreciation, meaning you want your investment to grow significantly over time. Given we're starting our first job, you likely won't need $10,000 soon, allowing you to take on more risk for potentially higher returns. The risk that concerns you most should be volatility, standard deviation, known as standard deviation, as this measures the fluctuation of returns and concentration risk, which is the high risk taken by following your colleague's advice to go, quote unquote, all in on Tesla. You should aim for a portfolio that maximizes return for a given level of risk, which is the core principle of modern portfolio theory. Moving on to represent, we must visualize returns, volatility, and correlation before optimizing. So before diving into optimization, visualizing the components is key, of course. Tesla is a high risk, high return outlier with a 35% average return and a massive 60% standard deviation, making its price extremely volatile. J&J and Exxon are the defense lower return and lower risk stocks. The S&P ETF sits in the middle with about 12% return and 80% risk, representing a balanced benchmark. The Vanguard Bond ETF is the risk-reducing component, offering the low risk of 4% standard deviation with our lowest return of about 3%. This key correlation shows that Tesla and Apple move somewhat together, about 65%, while the negative correlation between Tesla and J&J, about negative 10%, and the stock bonds correlation of about negative 20% are crucial for risk reduction, as they indicate these assets tend to move in opposite directions, or at least not perfectly together. So on our implement, we must build our portfolio analysis with real historical data. I will briefly talk about this, but come back to it in my coding collab. So the question of what happens to risk when you combine Tesla with bonds is answered by the negative correlation of about negative 20% between stocks and bonds when you combine two assets that are not perfectly correlated. Correlation is less than $1. The resulting portfolio risk standard deviation is less than the weighted average of the individual risk. Because the correlation is negative, the risk reduction is even more pronounced. For example, if Tesla has a bad year, its price drops. The bond portion of the portfolio is likely to hold steady or even increase, acting as a shock absorber, significantly reducing the overall portfolio's volatility. Compared to holding just Tesla, this is a clear demonstration of the free lunch for diversification. To validate this, yes, you can build. Sorry, I should refer to this. Okay. Compare your portfolio metrics with benchmarks like S&P 500. So yes, you can absolutely build a portfolio that beats the S&P 500 with return with less than risk by strategically exploiting the lower than perfect correlations. A sample portfolio achieving this might be 40% Apple and 30% J&J and 30% B&D. This mix avoids the extreme volatility of Tesla while also leveraging the strong returns of Apple. The B&D portion, while its negative correlation to stocks substantially lowers the risk of the overall risk. Comparing this to the SPY benchmark 12% return, 18% risk, a diversified portfolio can be constructed to have a return higher than 12% due to the Apple's 22% return. Because of the risk-reducing effects of J&J, lower volatility, and B&D negative correlation, the optimal mix for someone our age, of about 28 in this case, given a long time horizon, typically a growth-oriented portfolio focusing on high return assets like Apple and Tesla, but moderated by less volatile assets for stability. A possible optimal mix might be 40% Tesla, 30% Apple, and 20% J&J, and 10% B&D. This blend retains the high potential of Tesla and Apple while using J&J and B&D to benefit from low and negative correlations, driving down the overall portfolio risk. To evolve this, how does changing the mix affect risk and return? So correlation creates a free lunch or diversification because it allows an investor to reduce portfolio risk without sacrificing expected return. A concept central to modern portfolio theory. This free lunch happens whenever the correlation between assets is less than $1. If assets are not perfectly correlated, when one zigzags, the other may zag. Move in a different direction, or simply just move less. Thereby, by smoothing out the portfolio's overall returns by combining Tesla with J&J, which has a low risk and return, and B&D very low risk and return, the overall volatility is significantly dampened. For instance, the slightly negative correlation between Tesla and J&J of about negative 10% means J&J is likely to provide stability when the extremely volatile Tesla underperforms. In order to reflect on this, what surprised us about the diversification benefits, and can the historical returns and correlations predict the future? So what should surprise us most about the diversification benefits is just how little you need to sacrifice return to achieve substantial risk reduction, especially when using negative correlated assets like the B&D ETF. A small 10% allocation to bonds drastically reduces the massive 60% volatility of Tesla and 28% of Apple. However, it is crucial to remember that historical returns and correlations are not guaranteed predictors of the future. The past data provides a useful baseline for modeling, but market conditions, interest rates, company-specific news like Tesla drops a new product or releases or J&J lawsuits, and macroeconomic events like recessions and wars can cause return and correlation to change dramatically. Therefore, while diversification is a robust strategy, your portfolio must be monitored and periodically rebalanced. This is all I have. Moving on to my coding. Before I do this, I wanted to, in my Python notebook, we're going to analyze and we're going to do analysis and visualizations of the situation. So we analyze the situation. If we press play right here. So what do we have? We have years 2020, different days of the year. And we have Apple, B&D, J&J, SPY, Tesla, ExxonMobil, High Apple, B&D, J&J. So this is our price close. This is our price open. This is our volume of each. Sorry. So the subtasks require downloading historical stock data for specified tickers using Finance Library. This involves importing the library, dividing the tickers, and using the download function at the appropriate time period. We obtained historical data for the specific assets in the last 5 years. Is basically what this is. So data preparation. What's our task? We must clean and format the data for analysis. So calculate daily and monthly returns. So in order to calculate close prices, we do data of close. Daily returns is close prices times PCT change. Daily returns, again, would be daily returns. This is just display. So what does this exactly mean? We have our tickers here. Move out the dates. Our companies here, and these all show daily and monthly return rates. Return rates, I should say. So to analyze this, we just simply calculate average daily return, daily volatility, and the Sharpe ratio. So our average daily return is going to be about 0.000833. BND would be about 0.0001, JJ 0.00392, and so on and so forth. So these are our daily volatilities and the ratios, and these are our formulas to find this out. So we must analyze these correlations as well. So calculate the correlation matrix for the asset returns to understand how they move together. So in order to do this, we just have a formula of daily return correlation and display the correlation matrix. And if we put play, we can show the correlation matrix between each and every company that we have here. Analyze the suggested portfolio. So we must analyze the suggested portfolios by calculating expected returns and volatilities of the all-in Tesla and all-in SPY portfolios. So if we do this, we get a performance metrics should be Tesla and SPY, the average daily return, daily volatility, all counts into it is for Tesla, and so on and so forth. So this is for Tesla, the average daily return is higher than the average daily return for SPY, but it has a much higher volatility. So build and analyze these diverse portfolios. We must create several diverse portfolios with different asset locations, calculate expected returns, volatilities, and the Sharpe ratios. So to do this, we must use different formulas as all, let's follow this right here, and this, and this, and this. And these essentially spit out the return rates, the volatility, the Sharpe ratio, and the weights for each company. So to visualize this, we must perform the individual assets in diversified portfolios. We must create a set. For me, I wanted to create a scatter plot to portfolio performances, including individual assets and diversified portfolios colored by the Sharpe ratio. So if we press play on this code, this shows the portfolio performance in efficient frontier. It's the ratio. Blue is lower and then higher as you get higher. It turns yellow. X indicates the individual assets and diversified portfolios as the dots. So based on the analysis, provide insights and recommendations for building a portfolio considering the investment goals and risks. Analyze the scatter plot as we did and provide insights. And we must analyze the scatter plot. Excuse me. This involves interpreting the plot, identifying key assets, portfolio characteristics related to the investment. So we must analyze portfolio recommendations. Analysis of the scatter plot. The scatter plot shows the relationship between daily volatility and average daily return for individual assets in a large number of diversified portfolios. This individual assets are marked with the red X's, while diversified portfolios are marked with colored dots. The color of the diversified indicates the ratio, with darker color generally representing higher ratios. The cloud of our diversified portfolio represents various combinations of assets. The upper left edge of the cloud, one where portfolios offer the highest return for a given level of risk, represents the approximate efficient frontier. Individual assets with the highest Sharpe ratios. So we have, it goes from Exxon to SPY, Apple, Tesla, changing BND. So Exxon has a highest ratio among individual assets, indicating good risk-adjusted return, while SPY also has a relatively high Sharpe ratio. Tesla has the highest average daily return, but also the highest daily volatility, resulting in a moderate Sharpe ratio. BND has the lowest return and volatility and the lowest Sharpe ratio. Spread of diversification. Diversified portfolios in the efficient frontier. Diversified portfolios are spread across supply generally showing higher returns for higher levels of volatility. The darker colored points for the higher ratio shows tend to cluster towards the upper edge of the portfolio cloud, illustrating the efficient frontier. Portfolios on or near the efficient frontier represent optimal combinations of assets that maximize the return for a given level of risk or minimize risk for a given level of return. We must relate our visual analysis to investment goals and risk tolerance. So the effective frontiers are crucial. It's crucial for portfolio building. Investors should aim for their portfolio on or near this frontier that aligns with the risk tolerance. Low risk tolerance. Consider portfolios with lower volatility, even if they will offer lower returns. This will be for the darker spots on the left side of the frontier. For the high risk tolerance, we're going to explore portfolios on the right side of the frontier of the essentially of the chart, accepting higher volatility for the potential of higher returns. And recommendations we're gonna consider for low risk tolerance, we're gonna consider portfolios with a higher allocation to less volatile assets like BND and J&J, while also still including some allocations to assets with moderate returns like SPY. Focus our portfolios on the lower left portion of the frontier. For medium risk tolerance, a balanced approach could involve allocations across different assets classes, potentially leaning towards a mix of SPY, Apple, and Exxon with some allocation to lower volatility assets. And for high risk volatility, portfolios with higher allocations to higher returns, higher volatility assets like Tesla and Apple might be suitable alongside exposure to SPY and XLM. These would be the portfolios on the upper right portion of the efficient frontier. Finding the exact optimal portfolio requires further optimization, of course, based on specific risk tolerance levels. The plot provides a visual guide for trade-offs. I guess we can briefly go over the summary of insight recommendations. Analysis shows that diversified portfolios can offer better risk-adjusted return compared to individual assets. The efficient frontier visually represents the optimal risk-return trade-off for diversified portfolios. Portfolios recommended depend heavily on individual risk tolerance. Investors should select a portfolio on or near the efficient frontier that matches their comfort level. So I guess some key findings that we have for our summary: historical data, price data for Tesla, for all these for the last 5 years was successfully obtained using our research. Daily return to each assets were calculated and clean. Performance metrics included average daily return, daily, so on and so forth. Were all calculated, while Tesla had the highest average return, but also the highest volatility, and BND had the lowest return, the lowest volatility as well. Correlation matrix of daily returns were computed. 5,000 diversified portfolios were randomly generated. This guide visualized the risk for daily volatility versus the return, the average daily return of individual assets in the 5,000 diversified portfolios were generated, and so on and so forth. So that is my section 6 video. I appreciate you guys for watching, and thank you for your time.